Will A, I take your job amid booming economic data, Goldman Sachs, crisis or opportunity? Friends, imagine this. 10 years from now, you're at your office, and the colleague sitting next to you isn't a person, it's an AI assistant. It's faster, more accurate, and cheaper than you. Sounds scary, right? But Goldman Sachs believes there's more than just a crisis behind this. It may also present an unprecedented opportunity. The key question is, are you ready to work alongside AI? Hi everyone, I'm Qingqing, a seasoned investor with over 10 years of experience in the U.S. stock market. In this video, I'll analyze the market logic behind the current wave of strong U.S. economic data, what's really hidden beneath it, crisis or opportunity, and how will the rapid development of AI impact job opportunities for everyday people. Don't forget to like the video, follow my channel, and leave your thoughts in the comments. Let's get started. This morning, the U.S. released a series of heavyweight economic data showing an exceptionally strong economy. But, strangely, the market wasn't excited. Instead, it dipped slightly after the opening. It wasn't until midday that investor sentiment suddenly turned positive. With the S&P breaking through 6,500 points and hitting a new record high, why this shifts from early restraint to a surge later in the day? It reflects the dilemma investors are facing. Let's first look at the key data. Q2 real GDP seasonally adjusted annual rate grew 3.3%, revised up from 3.0%. Business investments stood out, revised significantly upward from 1.9% to 5.7%. Net exports contributed around 5%, hitting a record high. However, consumer spending, the engine of the U.S. economy, only grew by 1.6%, showing a noticeable slowdown. On the other hand, gross domestic income (GDI) grew by 4.8%, much higher than the 0.2% in Q1. This suggests the U.S. economy may be stronger than GDP alone, indicates and that companies are capable of passing on costs to consumers, which could raise inflation risks. Now, let's look at prices. The core PCE index, excluding food and energy, rose by 2.5%, exactly in line with expectations. Not low, but also not unexpectedly high. As for the job market, initial jobless claims came in at 229,000, lower than the previous 234,000 and the expected 231,000. Continuing claims were 1.954 million. Also lower than the previous 1.961 million and the expected 1.97 million. The simultaneous drop in both figures suggests the job market remains healthy and might even be warming up. This is exactly why the market feels both excited and concerned. Good data means a strong economy and profitable companies. But it also implies inflationary pressure could return and that the timeline for rate cuts may be pushed back. Investors are caught in this contradiction, cautious in the morning, optimistic by afternoon, ultimately driving the index to a record high. So here's the big question. Is strong GDP a new driver for the stock market or a hidden risk? Will AI become the next engine of growth or the biggest threat to employment? Leave your thoughts in the comments and we'll highlight the best ones in the next episode. Don't forget to like, subscribe, and turn on the bell so you won't miss our deep dive market analysis. Overall, today's data, whether from the breadth of economic growth, the resilience of the job market, or the stability of inflation, points to one fact: the U.S. economy is currently on very solid ground. But, ironically, this outstanding performance report is what's creating more confusion for the market. Stephen Staley, chief U.S. economist at Santander Capital Markets, commented, "Doubt today's data will change the Fed's mind. It definitely adds resistance to the path of future rate cuts." Karen Georgia is a fund manager at Eagle Capital, warned that the market is too confident in pricing in multiple rate cuts if the job market proves more resilient than expected. Investors may have to lower their expectations for monetary easing. In other words, strong data is a good thing, but it weakens the Fed's rationale for cutting rates. Directly clashing with Wall Street's current expectations, the market's cold reaction at the open reflects this logic. The sharp intraday rise in the dollar index and short-term Treasury yields also shows that investors are swinging between the stock and bond markets. Interestingly, after midday, sentiment reversed dramatically. The S&P surged from an intraday low of 6,466.96 all the way to break through the historical 6,500-point mark. What mindset does this reflect? Christopher Riley from Northlight Asset Management commented, "We might be overworried about tariffs. The economy is firing on all cylinders. This should boost market confidence. The expectations for a September rate cut have long been priced in. What matters most now is inflation. As long as the data doesn't spike, the stock market should keep climbing. We're still in a bull market unless there's a recession. In other words, the market logic has shifted. Rate cuts are no longer necessary. Strong economic performance itself is enough reason for markets to rise. As long as inflation doesn't flare up and there's no recession, there's no reason for a downturn. Many investors have observed that the market had been operating under a bad news is good news logic. Weak economic data increased the likelihood of rate cuts and more stimulus, but now the market seems to be returning to a more straightforward narrative: strong economy. In strong companies, strong fundamentals is the biggest driver of stock market gains. This driver may even outweigh the positive impact of rate cuts themselves. I personally agree that fundamentals are what truly matter. If market logic becomes overly focused on superficial factors like whether rate cuts are good or bad, it may distract investors and even lead to unnecessary losses. The core of the macro market still lies in balancing inflation and employment. As Jerome Powell has said, if employment weakens, the Fed may cut rates, but that kind of rate cut might not be good news for the stock market. If inflation gets out of control, the Fed will raise rates, which would be an even heavier blow to the market. In other words, if the delicate balance between inflation and employment is disrupted in either direction, markets could be hit hard. Lately, discussions around will AI take our jobs have intensified. On one hand, tech companies are constantly releasing more powerful AI models. On the other hand, layoff headlines are becoming more frequent. So the question is, will the widespread adoption of AI trigger a massive wave of unemployment? Goldman Sachs recently released a lengthy research report attempting to answer this question with data. If you agree with my analysis, don't forget to like, subscribe to my channel, and share your thoughts in the comments. According to Goldman Sachs projections, after analyzing over 800 occupations, they concluded that if AI is widely adopted, about 6% to 7% of the U.S. workforce may be displaced. During the AI transition, the U.S. unemployment rate could temporarily rise by about 0.5%. Why does Goldman believe the impact will be temporary? Because history tells us that every major technological revolution has ultimately created far more jobs than it destroyed. For example, 60% of today's American workers are in jobs that didn't exist in 1940. In other words, over 85% of employment growth over the past 80 years has come from technology-driven new roles. So Goldman's conclusion is that AI will indeed replace some jobs, but it's more like a growing pain, not a permanent loss. Which sectors will feel the pain first? The report warns that disruption has already begun in some fields: marketing, consulting, graphic design, office administration, and call centers, all showing a clear slowdown in job growth. Within tech itself, like computer systems design and software publishing, job openings are declining, especially among young professionals aged 20 to 30. As for the roles most likely to be replaced by AI, Goldman has offered a fairly clear list. High-risk jobs are typically those with repetitive tasks, such as computer programmers, accountants, and auditors. Legal and administrative assistants, customer service reps, and telemarketers. Low-risk jobs are those that require complex decisions, high levels of interpersonal interaction, or fine physical manipulation. Examples include air traffic controllers, corporate executives, radiologists, pharmacists, real estate agents, photographers, and clergy. Goldman researchers also emphasize that we're still in the early stages of AI application. The impact of AI on employment depends heavily on how employers choose to use it. As the report's authors, Brex and Don, wrote, before this AI cycle fully plays out, its disruption to the labor market remains an open question. I personally believe the threat of AI to employment is bound to be a temporary panic. AI can indeed replace some roles, but it will also create new demands we can't yet imagine. The reason is simple: human desires are endless. Once one need is met, another one emerges. That's the value of this report. It tells us there's no need to be overly fearful of AI's impact on jobs, while also providing a clear map of high-risk and low-risk occupations for young people. This serves as a good reference to plan ahead in their career paths. Ultimately, no one can completely avoid each new wave of technological change. What we can do is learn to use AI as a tool, make it your power-up. Use it to expand your knowledge, learn new skills, and even if you do face a layoff one day, you'll be able to bounce back quickly. Today, the U.S. Department of Commerce dropped another bombshell. They announced a pilot program to publish key data like GDP on public blockchain. This type of data is extremely influential and can move global markets. So what's the real intent behind this? According to Commerce Department officials, the goal is to provide a verifiable new distribution channel for economic data, not to replace existing methods. Specifically, they'll publish the official hash of GDP data to public blockchains like Bitcoin or Ethereum. The hash acts like a digital fingerprint, unique and tamper-proof. In simple terms, it gives economic data a blockchain ID that anyone can verify at any time. The intent is clear. In a noisy information environment, the U.S. wants to boost market confidence in official data through blockchain's immutability. But what's the point of this? The official explanation is that it's about verification, not publishing. They argue that government websites can be hacked and press releases may have errors. But once a data hash is on the blockchain, it's a permanent and untamperable record of truth. Sounds noble, but is that reason convincing? After all, tampering with US GDP data isn't exactly easy, putting such critical data on a blockchain just for verification. Things might not be so simple. Reportedly, U.S. Commerce Secretary Luttig revealed this plan to Trump in a White House meeting, telling him bluntly, "We're doing this because you are the crypto president." This statement directly links the move to the Trump administration's crypto-friendly stance. Trump's shift was visible for some time. From skeptic to staunch supporter, he's taken action, ordering the creation of government crypto reserves, appointing pro-crypto regulators, and signing laws to regulate stablecoins. More importantly, the Trump family itself is investing heavily in crypto, building media platforms with crypto vaults, and investing in prediction markets. Today, Trump's sons Eric and Donald Jr. finalized the merger of their Bitcoin mining company, American Bitcoin, with listed firm Griffin Digital Mining, set to debut on the Nasdaq. Post-merger, the Trump family and partners will own up to 98% of shares. With ambitions to become the world's largest and most efficient Bitcoin miner, this growing entanglement between politics and crypto only strengthens the trend of politicized crypto. As I see it, the U.S. Commerce Department's move to put GDP data on-chain may be a bold technical experiment, potentially a model for future data transparency, and a positive for the blockchain industry. But at the same time, the crypto space is becoming increasingly politicized. With government actions, the Trump family's business moves, and Trump's own diplomacy all tilting heavily toward the crypto world. All these developments send a very clear message to the industry. Crypto is about to receive unprecedented support in the U.S. I believe crypto will only grow more important, eventually becoming a core part of every investor's portfolio. As retail investors, our best move now is to understand this market, follow the trend, and stay informed. Meanwhile, another storm is brewing in U.S. politics. President Trump's attempt to fire Fed Governor Cook has escalated, with Cook formally suing to block the illegal dismissal. The legal battle is officially underway. According to court documents, Cook argues the firing has no legal basis. The mortgage fraud accusation, her legal team has clarified, it was likely an unintentional mistake. She may have accidentally labeled an investment property as a primary residence. More importantly, there's no evidence she benefited from it or did it intentionally. In short, it was a harmless error, not a reason for dismissal. Cook's team also stressed that Trump didn't give her any chance to explain before issuing the termination, violating her constitutional right to due process. She's now seeking a temporary restraining order to block the dismissal, I believe. The real issue isn't the small error. It's the legal interpretation of just cause under the Federal Reserve Act. If the court rules in Cook's favor, it would be a check on Trump's power and a strong defense of the Fed's independence, signaling to markets that the institution cannot be easily shaken. But if Trump wins, it would set a precedent that even trivial issues could be used to fire a Fed official, potentially threatening both Fed independence and democratic norms for markets that would likely be more harm than good. The case is still in its early stages, and the outcome will take time. I'll be watching closely and will keep you all updated. That's all for today's video. If you enjoy the content, don't forget to subscribe, like, and leave a comment. I'm Qingqing. See you in the next episode.